Welcome back to the Deep Dive. Today, we are getting granular with a true giant of the industrial economy, John Deere.
Yep, we've got the full stack of sources on their fourth quarter and full fiscal year 2025 results.
And maybe most importantly, we're going to be dissecting their forecast for 2026. This is where the story really gets interesting.
It is. Our mission here is to really understand how a company so tied to the commodities cycle handles a real economic inflection point. The market is slowing down, no doubt about it.
So we need to see where they're still making money.
Exactly. Where are they thriving? Where are profits getting squeezed? And what are the hidden cost pressures lurking just beneath those big revenue numbers?
And when you look at 2025 as a whole, you can see just how big this inflection point is. It confirms a really sharp turn from the peak we saw before.
It does. Let's just lay out the big numbers for you. For the full fiscal year 2025, net income was $5.027 billion.
Which sounds like a mountain of money.
It is, but it's a 29% drop from the previous year. That's a huge fall. And diluted earnings per share, they fell right along with it, down 28% to $18.50.
That signals a very rapid cyclical slowdown. But interestingly, the CEO, John May, his angle was all about resilience. He actually said they achieved our best results yet for this point in the cycle.
Right, which is the core idea we have to test here. How do you claim your best performance right when your earnings are taking a nosedive?
That's the question.
We're going to find out by looking at what they did internally. Was it cost control? Was it volume? Price increases? Because they're projecting 2026 to be the absolute bottom for the large ag equipment cycle.
Okay, so let's jump right into the core business. We're calling this the agricultural divide.
Good name for it.
Because the performance in Q4 2025 between their two main ag segments, it just could not have been more different.
We're talking about production and precision ag, or P&PA. That's your giant combines, your big tractors. And then small ag and turf, or SAT, which is more like your lawn mowers and utility tractors.
Let's start with the big stuff, the P&PA segment. Net sales for large equipment, they were actually up a pretty solid 10% in the fourth quarter, $4.7 billion.
That's great top-line growth, especially in a slowing market.
But, and this is the huge catch that jumped out at me, operating profit actually went down by 8%.
So they sold 10% more stuff.
And kept 8% less profit.
That right there, that is the clearest sign you can get that production costs are winning the battle against their price increases. That profit compression is severe.
How did the numbers break down?
Well, the sources show price realization was good. It brought in $122 million, and higher volume and mix, that added another $69 million. Those are serious gains.
Wait a second, so if they charged more and they sold more, how on earth did they still lose profit? Was this just bad cost control?
No, I'd say the headwinds were.
Yeah.
They were just massive and pretty much unavoidable. The biggest factor was higher production costs, which hammered them for a negative $147 million.
Wow.
On top of that, you had higher tariffs, and then this bucket they call special items, which we'll get into. But that dragged them down even more. It's just a combination that even the best operations can't really overcome.
So if P&PA was feeling the squeeze, the small ag and turf segment, I mean, its profitability just completely collapsed.
It really did. Net sales were up 7%, which is fine, hitting about $2.45 billion. But the operating profit...
It's a shocking number.
Shocking is the perfect word. SAT's operating profit plummeted 89%. It went from $234 million in Q4 of 24 to just $25 million in Q4 of 25. The margin basically evaporated.
So why? Why did the smaller, what you'd think is the more stable equipment, take such a massive hit compared to the big machines?
It's a mix of things, really. The headwinds just hit SAT harder. First, tariffs were a huge piece of it. That was an $85 million negative hit baked right into their production costs.
So they were more exposed to imports.
It seems so. The high volume of smaller imported parts probably made that tariff impact much worse than for the big, often domestically made P&PA equipment.
And what was the other major blow?
Increased warranty expenses. That sliced off another $65 million. So you take those two massive hits, combine them with high fixed manufacturing costs, and even the small sales gain they saw just couldn't save the margin. It's a perfect storm.
Okay, but it wasn't all bad news. Let's look at the parts of the business that were actually stable or even growing. I'm talking about construction and forestry and financial services.
Right. If ag was the big challenge, construction and forestry, or C&F, was the counterbalance. That segment saw its sales surge a massive 27% in Q4.
27%. That's not just growth, that's real market strength. It hit 3.8 billion.
And unlike in ag, that growth translated much better to the bottom line. Operating profit was up a healthier 6% to $348 million.
Why the difference?
Volume leverage. It's the exact opposite of what happened in small ag. C&F had its own production cost pressures, a negative $125 million hit. But the sheer volume of new shipments completely overpowered that.
So they just sold that much more.
So much more. Higher volume and mix had a positive impact of $235 million. They sold so much more equipment that the efficiency gains just absorbed all those rising costs.
And we can't forget financial services. That's often the quiet hero for companies like Deere.
And it had a fantastic quarter. Net income there was $293 million. That's a 69% jump over the same quarter last year.
What drove that?
Mostly favorable financing spreads. So they were just making more money on the loans they write. And just as important, a lower provision for credit losses. That's a big vote of confidence in their customers' ability to pay their bills.
Now, before we look forward, you mentioned those special items. We should probably circle back to those because they really did skew the overall picture for 2025.
Yeah, they did. These are one-offs, but they show the kind of friction they're dealing with. In Q4, there was a $95 million pre-tax charge for an antitrust lawsuit.
That's a big number.
It is. And earlier in the year, in Q3, they took another hit, a $61 million impairment charge, mostly related to some overseas battery operations. All told, that's over $150 million in non-operational losses that made the year look a lot worse than it was.
Okay, so let's take all of that and look forward. The 2026 forecast really tells the story of where we are in the cycle. If 2025 was tough, it looks like they're signaling a definitive bottom for large ag.
Without a doubt. The overall company forecast for FY 2026 is for net income to be somewhere between $4 and $4.75 billion.
And they just finished 2025 at over $5 billion.
Exactly. So they're forecasting another decline. Management fully expects this downturn to get deeper before it gets better.
And the pain seems really, really concentrated. When you look at the industry unit outlook, where's the big slowdown?
It's all in their backyard. The U.S. and Canada large ag segment, which is their highest margin stuff, is expected to see unit sales fall between 15 and 20%.
15 to 20. That is a massive drop. It really sets the tone for everything else.
It does. But the rest of the world and other segments look, well, a lot more stable.
Which suggests this is really a North American crop issue, not a global collapse.
Precisely. Europe ag is forecast to be flat to up 5%. South America, flat. And the segments that were stable in 2025, they expect them to hold up. Small ag and turf, flat to up 5. Construction, also flat to up 5.
So the burden of growth is really shifting away from their traditional core business.
And you see that in the financial targets. P&PA sales are forecast down 5 to 10%, with margins tightening a bit. But on the flip side, small ag and turf sales are forecast to be up around 10% with better margins. Same for construction, also up about 10%.
The strategy is clear then. Small equipment and construction have to carry the company while the big machines are in a recession.
That's the playbook for 2026.
But what's so fascinating is that even as they forecast this huge industry drop, their own retail sales in late 2025 were incredibly strong compared to everyone else.
That is such a critical point. It shows their competitive strength. The retail sales data from October 2025 shows Deere just dominating. They sold 17% more big tractors than the industry average.
And combines.
20% more than the industry average. They are absolutely consolidating market share.
So even as the whole pie is shrinking, they're grabbing a much bigger slice.
Correct. But they still have to deal with that 15 to 20% drop in total demand. It's great positioning, but it doesn't change the market reality.
Okay, this is where it gets, for me, really interesting. Beyond the cycles, let's talk about the non-cyclical challenges, the legal stuff, their tech strategy. This is what that $1.4 billion in capital expenditures is all about.
And it raises the question, how much of their future risk is about grain prices versus, say, policy and litigation? And the answer is a huge amount. Their own forward-looking statements specifically call out the risks from that lawsuit filed by the FTC.
The Federal Trade Commission in several states, right?
Yes. The suit alleges they unlawfully withheld self-repair capabilities from farmers. This is the whole right to repair debate, and Deere is right in the middle of it.
Which is not just some legal fight. It hits the very core of their relationship with their customers.
It really does. I mean, for a farmer, a $500,000 machine is everything. If they can't fix a small problem themselves or call their local mechanic, they're stuck. Deere's model relies on controlling those repairs, and this lawsuit challenges that control. It's a huge operational risk to watch.
And that's why their tech strategy, that growth up, down, and across the tech stack, is so critical. They're spending all that money to future-proof the business.
Absolutely. The investment is all focused on things like autonomy, so self-driving tractors, machine IQ, connectivity for real-time data.
Yeah.
They are betting that the efficiency from these smart machines will keep farmers buying even when commodity prices are low.
Making the farmer more productive.
Produce more with less. That's the value proposition.
And speaking of cash, their priorities for using it seem really disciplined as they head into this downturn.
Very conservative playbook. Priority number one is keeping their A credit rating, then funding operations and growth, like that CapEx. Then, a moderate dividend increase. Share repurchases are dead last.
It's a structure built for survival, not for aggressive expansion right now.
Yeah, that's right.
So, if we pull this all together, what have we learned? Our deep dive shows this fundamental shift. 2025 wasn't about a lack of demand. It was about getting hammered by production costs, tariffs, and those big one-off legal charges.
Yeah, the overall story is that Deere's own improvements are being tested by these outside pressures and the market cycle. Their resilience in 2026 depends completely on small ag and construction holding the line, while their main business in North America goes through a pretty deep but probably unavoidable contraction.
The one domino that I think we need to watch all next year is inventory. You pointed out that Deere's combine inventory nearly doubled, from 4% in 2024 to 8% in 2025.
That is the essential question going forward. When demand shrinks by 15 or 20%, inventory management is everything. Dealers do not want to be sitting on lots full of expensive combines that aren't selling.
So what happens?
Well, if that inventory keeps climbing, what does that do to prices? To dealer sentiment? You can't control inventory without offering deep discounts, and that could just erase all the gains they've made from their tech investments.
That inventory pressure is the real test of whether they can actually maintain that best results for this point in the cycle claim.
It is. And we'll get our next major update with the first quarter 2026 earnings call. That's scheduled for February 19th. Keep your eyes on that date.
Will that surplus of steel weigh down their margins?
Or will their market share gains let them absorb it better than their rivals? That's what you need to track.